The Federal Reserve recently made a major change to the monetary system, and most people will only understand what it really means when their paycheck no longer covers their needs. For nearly 3 years, the Fed was pulling money out of the system to control rising prices. Interest rates were raised, liquidity was drained, the balance sheet was reduced. This process is called monetary tightening, also known as QT, and now the Fed has officially stopped it. This does not mean that quantitative easing has started again, but it does mean something very important. The Fed is no longer removing money from the system. So what does this mean? What does a change like this actually affect in our daily lives? Most of all, how far your salary can really go, because balance sheets, liquidity, tightening, easing, rate cuts, reserves, these sound like abstract concepts. But these abstract concepts rewrite the rules of the entire monetary system. So let's break it down simply. Money is not created the way most people think. When the Fed wants to stimulate the economy, it does not. Take cash out of a vault, raise taxes, sell assets. It creates money digitally. Put simply, quantitative easing means adding more money and more liquidity to the financial system. How does it work? First, the Fed decides that the economy needs support, spending has slowed, growth is weak, or there is a crisis. The Fed creates new digital dollars. These dollars did not exist before. They are created electronically. Then, with this newly created money, the Fed buys assets, primarily U.S. government bonds, from large banks and financial institutions. This is where most people misunderstand the process. The Fed does not buy these bonds with existing money. It does not borrow. It does not raise taxes. It creates the money and uses it for the purchase. Banks hand over the bonds and receive newly created cash. On the Fed's balance sheet, bonds increase. On bank balance sheets, fresh liquidity appears. Because banks now have more money, they can lend more. More credit is issued. More businesses are financed. Home and car purchases are supported. More credit means more money in the economy. This is how money is created in the modern system. Not through printing banknotes, but through balance sheets and credit expansion. Between 2020 and 2021, the Fed didn't just print money, it printed aggressively. Trillions of dollars were created. The Fed's balance sheet jumped from roughly $4 trillion to $9 trillion. At the same time, interest rates fell close to zero. Borrowing became extremely cheap. The government sent direct checks to households. So the system was flooded simultaneously with more bank liquidity, more government spending, cheaper credit. But the supply of goods and services did not increase at the same pace. Supply chains were disrupted, factories shut down, production capacity remained limited. So what happened? Too much money chasing the same goods, and that pushed prices higher. By mid-2022, inflation reached 9%. But not everyone was affected the same way. Some people benefited enormously. Asset prices surged, home prices exploded, stock markets delivered extraordinary returns. For most people, the story was very different. Wages increased, but not enough. Savings lost purchasing power. Rent, food, insurance, and healthcare costs surged. If you did not own assets, you effectively became poorer. One side grew wealthier through assets, while the other was crushed by rising living costs. This was not a mistake. New money reaches the financial system first. It flows in assets first. By the time it reaches wages, prices have already risen. That's why many people felt left behind while headlines talked about a recovery. Then the Fed hit the brakes. In 2022, it reversed course. Interest rates were raised rapidly, borrowing became expensive, spending slowed, and monetary tightening began. The Fed stopped reinvesting maturing bonds. When bonds matured, they were not replaced. When that happens, money disappears from the system. The balance sheet shrinks, liquidity falls, credit becomes harder to obtain. This continued for almost 3 years, but tightening has a cost. Banks become cautious, lending slows, investments are postponed. Housing becomes less accessible, credit card rates rise, and eventually growth weakens. So where are we now? The Fed sees that the damage caused by further tightening now outweighs the benefits. The scale has tipped. That's why QT was stopped. This does not mean QE has started again, but it does mean this. The Fed is no longer draining money from the system. The Fed is now talking about rate cuts again. Why? Because layoffs are increasing. Unemployment is rising. Job growth is slowing. The Fed does not want a recession, but lower interest rates come with trade-offs. They make debt cheaper. They encourage spending. They keep inflation alive. This is a difficult balance. And remember, even if interest rates fall, mortgage rates may not fall immediately, because mortgage rates are tied to the 10-year Treasury yield. The U.S. government is heavily indebted. That debt must constantly be rolled over. The higher the interest rate, the heavier the burden. This is not ideology, it is mathematics. Now add artificial intelligence to the picture. Companies can grow with fewer workers. In a debt-based system, this is dangerous, because debt depends on future income. When the future becomes uncertain, the system leans towards stimulus. That's why many believe another period of monetary easing is coming. In the system, doing nothing is also a decision. Holding cash is a position. Avoiding investment is a strategy. And history shows that during expansionary periods, cash steadily loses value. Slowly, but relentlessly. That's why people feel trapped. But the system is not emotional, it is mechanical. When liquidity increases, it rewards asset owners. It punishes those dependent on wages. The end of monetary tightening is not good news, it is a warning. A signal that the system has reached its contraction limit, and history tells us this. At this point, direction usually changes. You cannot control policy, but you can control how you respond to it. The biggest losers are not those who make mistakes. They are those who believe nothing has changed.